Hey everybody, welcome back, man. It's been a whole week. I can't believe it's been a whole week since we've seen each other, but hey, here we are again. It's another Monday night. I need to come up with a name for this, I don't know, like Monday night morning or depends on how the market does, right? I don't know if you guys got any ideas for me on what should we call this Monday night time we get together. Just put your thinking caps on that, and let's see what we can come up with. I think that'd be kind of cool to have a name for it. Right now it's just Monday night live stream, but I think we can be more creative than that. So we got a nice program tonight. We're going to talk about some of the questions for Kevin that's in the Discord. If you're not a part of the Discord, you should do that. It is free to join that. And there's about 100 people in there now. It's really getting to where there's some cool conversations about stocks and about economics and, earnings and all kinds of cool stuff's going on in there. So if that's something you might be interested in, maybe joining a group of like-minded investors, feel free to join the Discord. The link is in the notes to this video. It is free to join, and we'd love to have you there. So with that, I'm going to get into some of the questions here before we get into the questions. So and I saw this as I was logging in, and so John Jay has a question for me. And so just so you know, I just finished dinner. I mean, I am right on the heels of having dinner. And my little granddaughters are here, my daughter as well. So we've been having a great time. And I said, hey, I got to go do this live stream video. So, for you guys, I'm going to be here for you, man. Sometimes you just got to make sacrifices, right? So anyway, here's the question from John. The question is this: since you're retired, or for those that are, what happens if and when the market takes a 50% drop? That's a pretty big drop, but hey, it could happen. And the economy goes into a tailspin, and that could happen as well. As a highly informed investor, how are you investing for that? I'm not sure about the highly informed investor, but as an investor, no. Here's the way I approach it, John, and I think it makes sense for retired people, especially, and that is to be a dividend investor. And so here's kind of the way I look at it. Just let's think about the big picture, right? The big picture is. And it's no different than when you're actually working. You have expenses. And so if you are disciplined and you have a budget set up for your household, you know what income you need to make, and anything above what you need to make, you can actually either save or invest or whatever, right? Well, it's the same thing when you get retired. So when you're retired, you have a budget, and that budget is expenses, it's utilities, it's taxes, it's food, it's gas, it's, whatever else expenses we have. So we add all of that up and we say, okay, here's my expenses. Oh, and by the way, I do like to travel a little bit. So we throw a little bit in for traveling as well. So at the end of the day, that's the income that I need. I need income to cover those expenses, right? So when I am a dividend investor, that income coming straight from those companies is what gives me my cash flow. It is not the market value that gives me my cash flow. Now, in your example here, if the market dropped 50% and the economy goes into a tailspin, then I guess maybe we have to worry about dividends as well. But let's say maybe it's not as draconian as your example. Maybe it drops 20%, maybe it drops 30%. And the economy falters, but it's not like a depression, right? So, in that case, then the companies that I select that have solid balance sheets, great management teams, a good valuation, and, solid strategy, good capital allocation, those companies are going to fare much better than some of the other companies. So if something like that were to happen, then I'm counting on my dividend stream. Maybe they're not going to raise it, but maybe it will continue, right? So that cash will continue to come in. I don't have to sell my shares at a depressed price. So there's a lot of value in that, and there's a lot of people that miss that piece of it. So I appreciate you asking the question. Hopefully that makes sense. So the dividend stream coming from those companies is my income, and that income, now I do have other sources of income, but let's just say I only had dividend income. Then that dividend income is the source of my income. It needs to be higher than my expenses. Whatever I don't use, I can reinvest back into the market or save or do whatever I want to with it, right? So that's kind of the way I look at it, John. I mean, I'm kind of a simple-minded guy when it comes to finances, the personal finances, because it's really about making more than you spend. And so if I get my budget right and I know what my income level is and my dividends cover that, hey, I'm good to go. The market can do whatever it wants to do. So that's kind of my thought. I got to see some other responses here. We'll hit those real quick before we get into what I actually came to talk about tonight. So Michael Swami is in the house. Good to see you, my friend from Texas. He says he continues to use his ever-growing dividend income to pay his expenses. There you go. That's he said it much more concisely than I did. So that ever-growing stream of income, which is your dividends, is a great way to go. All right, let's see who all's in here. Michael, I see your question here. I'll come back to that here in a second. I think it's a great question. So we got Kevin Mendoza. We got 2 Kevins in the house now, so we can get started. That is a quorum of Kevins. So, all right, Slammer 6789. Good to see you here, buddy. He got here early. That's awesome, my friend. Pat is in the house, and Pat's got good internet now that he's back in the great state of Minnesota. Let's see. So Kevin, you need the dividend therapy couch again, and that's great, man. I'll pull it out here. It's a little futon, really, but hey, it works. When you're on a tight budget. So Shaping, the Discord is awesome. I recommend y'all join it. That's great. Thank you, Shaping. I appreciate that. I think it's awesome too. I mean, I'm on there, but I tell you what, most of the conversation happens without me in it, and I think that's fantastic. I mean, it's a group of people who are really working together to become better investors. So, sometimes we disagree, and it's okay. We can disagree without being disagreeable, right? So we don't all have to have the same opinion about anything. We can state our opinion, and others can state theirs, and we can just move on. Money Monday, John Jay. That might work. We'll put that on the list. We might have a vote. All right, we got X to the who. X to the what? X to the who? X Dividend Dad is in the house. Good to see you, my friend. We got Mr. Income Fenders 53. We got OJ is in the house. Nice to catch you live. It is nice for you to be here live, my friend. Greg made it. I appreciate you being here, buddy. Tutomi. Welcome, my friend. Let's see. Pat also responded. He said, I'm retired and living off dividends. My rule is to never draw more than 60% of my dividends. That's a great rule. This way, my portfolio can still grow in hard times. I should be able to still draw some dividends. So that's a great rule, Pat. So basically, you're saying that if you go up to your 60% limit, then you got 40% of your dividends that you can then reinvest in the market. So not only are your dividends growing, but your stocks are growing and you're able to pour money back into it. So I think that's a great show, my friend. Wow, Russ, my friend from Dapper Dividends is in the house. He's added more SCHG today. That's great. Mr. El Dynamico is here. Good to see you, my friend. And let's see. I think what we'll do now, I'll come back and catch some of the rest of these. But let's go ahead and jump into the questions for Kevin. And I think these are going to be pretty interesting. So I didn't put these in any particular order. Before I get there, let me do this. I wasn't planning on doing this. Actually, I won't do it. In the Discord is a channel that is called Questions for Kevin. I thought it was kind of cute to have two K's there. So, but it, KUES wouldn't work. So I did KW. So Questions for Kevin. Yeah, it could be a little bit corny, but hey, that's all right. I live in Alabama now, so I can be corny. So questions for Kevin. We had two that I'm addressing tonight. I'm starting to pick up the pace because we are getting more and more questions. So I don't want to get too far behind on those. And so tonight we're going to talk about a question that came from Gnome about payout ratio variances using different apps. He was looking at a particular company we'll talk about. And in one app, it was a lot bigger number than it was in a different app. So I'll talk about why that is, at least for that one company. And then I got a question on, do I have any updated thoughts on Air Products, ticker symbol APD? And I do, and I shared those with my inspiration folks. And so I'll share that information with you here tonight on the live stream. So with that, let's go ahead and get started. So the first question came from Gnome. And he said the J&J dividend, or Johnson & Johnson dividend yield was 3.14%. I think there was a different conversation going on. But then he said, can you take a look and explain the dividend payout ratio of Johnson & Johnson, which by the financial sites is 90.38%. So if you guys, follow the payout ratio, a 90% payout ratio is pretty high. So if Johnson & Johnson has a 90% payout ratio, it would be a shock, right? So, but, he sent me the website that it was on. It was actually on Yahoo Finance, and they did show a 90.38%. It's not 90.38% now. I put the slides together today. This question came in, as you can see here, on April the 10th. So I'm a little behind. But anyway, that's about 12 days ago. So the first quarter earnings have come in, and the websites have updated their payout ratio. So what you're going to see tonight is not 90.38%, but it was 90.38% when he asked the question. And so I thought I would walk through what is causing that, because it's important for us as dividend investors to know what the data is that we're looking at and what the foundation is behind it. So here we go. Earnings payout ratio. And you can see the little icon here that is Simply Safe Dividends. You can see that Simply Safe Dividends has, Johnson & Johnson with a payout ratio in the mid 40% range, which is a very reasonable payout ratio to have. You can see that Tip Ranks here has a payout ratio also in the mid 40s. So that's a reasonable thing, and it's pretty consistent with what we're seeing in Simply Safe Dividends. However, when you flip over to Yahoo Finance, even after the first quarter, their dividend payout ratio shows 64.06%. So that's obviously a bit inflated compared to these other apps. So why would Yahoo Finance have one number and Simply Safe as well as Tip Ranks have a different number? Well, let's take a look at it. So this came from the earnings announcement that Johnson & Johnson had. You can see that they had 21.4 billion with a B dollars in sales for the first quarter. That is so much money. Imagine if you had that stacked up. I wonder if that would go to the moon or not. But anyway, it's a lot of money. And you can see here that they have a diluted earnings per share of $2.20. And then you follow my cursor to the right, and you'll see that they have an adjusted diluted earnings per share of $2.71. So the point is, Yahoo Finance is using the $2.20, which would be called the GAAP earnings, generally accepted accounting principles, and the other apps, probably everyone else, typically uses the adjusted earnings per share. So I'm going to talk a little bit about that. We've had a little discussion on this before, but it is good to kind of rehash some of this. So you have two earnings that typically get presented by a company. The first one would be their GAAP, their generally accepted accounting principles earnings. But what they want to share with their shareholders, is what do the earnings look like from a going forward perspective. So if there are some one-time items that are coming up, for instance, when a company purchases another company, that's called a merger or an acquisition, there are costs associated with integrating that. So for instance, they would want to take the IT systems and actually convert the new company, the acquired company, onto the IT systems of the current company. It costs money to do that, consultants and software and all of that. So, but that is not a ongoing expense. It is really an expense related to that acquisition. And so from an investor perspective, it's not something that we should expect to continue into the future. So they take that out of the earnings and or take it out, which really in this case, that would be an expense. So that's really adding earnings back to the company. So we're really looking at what earnings will go forward. And that's what the $2.71 is. So hopefully that makes sense. I've probably spent way too much time on that. You guys probably all know this, but I just, in my mind, I think of somebody that's joining us, maybe that hasn't even said anything in the comments, but they're going, I don't really understand the difference between GAAP earnings and adjusted earnings. So anyway, a couple more things. One is that on Johnson & Johnson, every company, not just Johnson & Johnson, but every company that I know of, reports a GAAP and an adjusted number. Some of them have a bigger adjustment than others, but they are all required by the SEC to have a reconciliation between the two. So if you wanted to say, what's the difference between Johnson & Johnson's $2.20 per share versus the $2.71? What are they putting back into earnings? You can look at this amortization here, and I'll try to make this a little bigger so you can see it. And they'll usually compare it. Maybe I'll move it this direction if it'll move. There we go. They'll usually compare it to the previous year quarter. And but you'll see here it's things like they must be amortizing some intangible assets, which is something they've concluded that needs to be added back to earnings. This is an interesting one. This is the litigation. So for Johnson & Johnson, they got this talc insurance issue, and that talc, not insurance, case. There's a case out there for litigation. And if you recall, last first quarter of 2023, they booked a $6.9 billion reserve for that. And so what they did is they said, hey, that's not something that is going to continue, in the future. We're booking an entire liability at this moment in time. Let's strip that out of the adjusted earnings so that investors would understand what it would be without that. So you can see kind of how that works. So every company is required to have a reconciliation of their non-GAAP financial measures. You can see that up here. So you just have to look, and they all put it in different places. They try to hide it, so you just want to try to find it. Some of them put it on their website. Some of them actually include it in the presentation materials. So you just have to look for it as long as it's available. That's the only requirement. Okay, let me see here. So to sum this up, the payout ratio is typically based on adjusted or normalized earnings. So most everybody uses adjusted earnings when calculating the payout ratio. It just makes sense because you really want to know what's the payout ratio moving forward for the company. Yahoo Finance, however, calculates payout ratio on the GAAP earnings, and that's why there was the difference. Payout ratio is based on GAAP earnings. Payout ratio based on GAAP earnings is accurate, but it gives little insight into the going forward performance of the business. And so that's why everybody uses typically that adjusted or normalized earnings. All right. Hopefully that was helpful. Thanks for the question, Gnome. It was a great question. And now let's move on. This one's kind of tiny, so I'll read it to you. My buddy Jim Betts, hopefully he's in the house tonight. He says, any changes to your thoughts on Air Products and Chemicals? I see that Seeking Alpha downgraded its quant rating to a sell. Wall Street and Seeking Alpha analysts still show as a buy. And the answer is yes. I've got some updated thoughts on that. As a matter of fact, I bought some shares. So this is information that I shared on my in my Discord for those that are in the inspiration part. And if you don't know what that is, you can look in the comments below this video and you can see, follow the buy me a coffee thing. You can see how to be a part of that. But anyway, this is what I gave to them on the 17th. So that was 5 days ago. It says, I've been watching the markets. I've been watching the market's treatment of Air Products. While I am not expecting Air Products to turn around tomorrow, I am making the decision to overweight the stock in the Wealth Circuit portfolio. Seeking Alpha shows an 18% upside. TipRank shows a 15% upside. Morningstar just upgraded APD and two of its competitors to wide moat companies and shows Air Products trading at a 26% discount. Air Products rebound will depend on the overall economy rebound, which the market will anticipate at some point. APD or Air Products will soon join Pinnacle West, Microsoft, and Johnson & Johnson as positions that are more than 4% of my portfolio. So that is, those are kind of my thoughts there. I did put together a slide that went along with that, and you can see, maybe you can't, I'll try to make it bigger. Here, I'll take me off the screen. That might help. You can see that, this is the price target for Seeking Alpha. And this is where I got that information. This is the 26% discount from Morningstar. If you're curious about what three companies were upgraded to wide moat by Morningstar, it is Air Liquid, Air Products, and Linde. I think that's how you say that. So they all went from narrow moat to wide moat with Morningstar. You can see that Air Products has a 95, a very safe dividend rating. And so because of all of that, I chose to overweight this particular stock in my portfolio. And then a little bit later, that morning, I went back to them and I said, hey, I bought 60 shares of Air Products at $228.80. My average price is now below $240. So the Wealth Circuit portfolio is overweight. It's about 4.85% of my portfolio. And I share that with the Inspiration members. Air Products is one of 4 overweight stocks in the portfolio. I think I already said all of that. But so anyway, there we go. Those are my thoughts on Air Products. And with that, I'm going to stop sharing that screen. And let's get back into here. I think there was a question that I skipped that I said I was going to come back to. And it's Michael Swami, because it really ties in well with what we just talked about. He said, what is your take on Linde PLC versus Air Products? So I think, Michael, I think Linde has a better, what do I want to say? They have a better product line, not a product line. They have a better footprint in the world regarding these gases. I think they are better set up. However, I do also believe that it is tough to change out when a company has a particular company, when a manufacturing plant uses a particular company's gases, that company will own the pipes and things and the infrastructure to get that into the plant. So it's really costly to, it's not like they're delivering bottles of gas and you just have to pick which gas you're going to use. There's an entire ecosystem for these gases, and they are, would be required to put their own ecosystem in, because that's what they would have their people trained on and how to repair those. So, having, for Lindy to push APD out of any plants or vice versa will be a very difficult thing. The barriers to entry are pretty high. However, I do like Lindy a lot. The thing that moves me to APD, though, is valuation. I think Lindy is overvalued. Matter of fact, let's take a look at it. We'll go to Morningstar, which means now I have to share a different screen. But I think we can do that. I think we are built for that. There we go. So I'll take your comment off of this screen. And okay, here's Morningstar. So I will pull up Lindy. So if I can get in there, LINDE. It is ticker symbol LIN. And you can see here that the fair value, according to Morningstar, is around $425. So the current price is around $446. Let's take a look at, for example, Air Products. Well, I think I mentioned that earlier, but just for grins, let's go to Air Products and Chemicals. You can see here that the fair value, according to Morningstar, is $307 versus the current price of $231. So I'm looking for, not only growth in the business, because I think Air Products has invested and is continuing to invest in growing their business. I think when the economy improves, Air Products is going to move up as well. I'm hoping that it's going to be at a similar trajectory to Lindy. However, I believe Air Products valuation is much better. I'm getting a better bang for my buck with Air Products. So that's why I like Lindy, but I like Air Products because I think I'm getting a better bang for my buck there. Hopefully, Michael, that makes sense. And those are my thoughts on that. Let me get this back here. All right. And Michael is long Air Products, so that's good. Well done, my friend. Let's see. I forgot where I left off. John Jay, this Monday. So if you've just joined us, we're trying to come up with a name for this live stream on Monday. So put your thinking caps on for that. But this reminds me of a Karen Carpenter song. I'm not sure why. But anyway, it's good. I think we'll put that on the list for sure. Let's see. I did that. I think. Okay, here we go. Greg's got one. Monday Night Insights with Kevin Burgess and his flocks of chicks. We need some word for insights that rhymes with chicks. So I don't know. Monday Night Clicks with Kevin and his chicks. Something like that. Who knows? Now, I don't know if my wife would really go for that either. So I don't know. Let's keep thinking. So yeah, Greg says it's got a ring to it. It absolutely does. Let's see. Oh, Russ says, hey, if everybody had the same opinion, it would be boring. And my friend, you are right. And that's really kind of what makes it work, right? What makes this Discord work. It's what makes live streaming work, is that all of us can have a different opinion and it works, right? And just because I have an opinion doesn't mean it's the right one. It's right for me, but it might not be right for you, because it's not that there's a right or wrong investment. And that's something that we forget about, right? So someone will say to someone else, you need to invest in blah, whatever blah is, right? But what they don't know is what your goals are, what your plans are, what your risk tolerance is. So when somebody says you really need to have this stock, they're giving you an opinion based on what they believe about themselves. So we take that with a grain of salt and we think about what we need for our investments and we make the best decisions for us. Tutomi says, what do you think about VST? My average cost is 24.12. So let's, I don't know, let's go over. I'm trying to think of what VST is. We'll get there. VST. Let's get out of that one. I got to find my cursor. There we go. Oh, I haven't even logged in yet to Simply Safe Dividends. How about that? So we're going to look up VST. Oh, Vistra. Is that the print company? Oh, no, it's a utility. Wow, it's a utility that I've not heard of. That's shocking. All right, it's an independent power producer. It's got a 60, which is borderline safe dividend. The yield is 1.29 for utility. That's pretty low. So makes me wonder. Their net debt to capital is 68%. That's not terrible for a utility. Low payout ratio. That's a good sign. They've got they're brand new. That's when I say brand new. They're pretty new, at least for paying a dividend. Let's see how long. Yeah, their data is relatively new. I retired in 21, so they had just been around for a year or two when I retired. So I'm not real familiar with them. I'm usually pretty familiar with the utilities. They have a 16.5 PE ratio. Their earnings payout ratio is all over the board. They must have had some issue it's probably because they're an independent power producer. And so they are, as an IPP, they are highly subject to the wholesale power market. So if demand drops off, which probably happened in 21, they would be, or let's say it was a winter that was really terrible and prices shot through the roof, they would have to be on the hook for any excess demand that they needed to provide to customers. So let's see, EPS looks pretty decent. It looks like it's going to fall off a little. It's fell off a little bit the last 12 months, but they're going to rebound in the next 12. Return on equity looks pretty good. Let's look at where's the return on invested capital? Did I miss that? There it is. Well, 13% for utility is not terrible, actually. So yes, it's the only thing is their interest coverage is a little low. That means their debt's pretty high, but their debt looks reasonable. So it makes me think that maybe something else is going on. So I think you'd want to check into that. They are a little bit, their yield's a little bit lower than it has been historically for the last 5 years. But that just means that people are more interested in their stock, and so their stock prices run up. So it doesn't look terrible. One of the rules that I use is that I want a company that has paid and grown its dividend for five consecutive years. So it's not something I would invest in simply because I have that rule. And obviously rules are meant to be broken, but hey, it is so your average cost is $24.12, and I'm in the wrong place here. Hold on. There we go. Wow. The price is $66.72. Yeah, if you're in at $24.12 to Tommy, I would say hold on to it. I don't see anything wrong with it at this point. I don't know anything about where their service territory is or anything like that. I tell you what, just because you're in it at such a good price, let's go to if I can catch it. There it is. Let's go to let's see if Morningstar has anything about it. And they do. They say it's a little bit overvalued. It's at 105%. Oh, wow. That's pretty high. They say the fair value is $32 and it's trading about 66. Makes me wonder what's causing that, because that is really high. I tell you what, I'll take this offline. I'll take a look at it a little bit more and see if I can come up with anything cool for you, and I'll let you know in the Discord to Tommy how any thoughts that I have on it, because it would take me a little while to kind of figure out where they are, what their markets are, and that kind of thing. So. But But that's a great question. You're in it at a great price, my friend. That is really good. Mike Shalednik is in the house. He said, "Let's go. We're going, my friend. We are on a roll." I need a walk-up song like you. There you go. Ex-Dividend Dad is cool, man. He's got the song, buddy. So smoking my VGR stock. Oh, that's awesome. Kevin says hi to Russ. Let's see. Man, Michael bought 10 dividend growth stocks today. That's awesome, man. You are on fire. So Russ is sitting in crash traffic after working late. Sorry to hear that, my friend, and hopefully we can entertain you. But hey, keep your eyes on the road and your hands on the wheel. Maybe you can just listen to us in the background, and that would be just fine. We want you to stay safe, my friend. Let's see. All right, we got Russ again. He's got a question for us. He says, do you think when we have fully autonomous vehicles that everyone had, it will collapse the auto insurance industry? That's a great question, Russ. The answer is I don't know. But what I'm thinking is that, maybe it's that, the bugs haven't been worked out. But I have heard of some crashes and some pretty serious crashes using these autonomous vehicles. So I don't know. I still think people want control, and I don't know. I guess if I think far into the future, I can see the government regulating the speed at which they can travel. Maybe you get in and you push a button and you're going somewhere. But I think here in the next 10 years, 15 years, 20 years, people are going to want control. They'd love to be able to drive as fast or as slow as they want to go. I still think we're going to see some challenges there. But, we'll still have to have insurance. And they'll probably still keep the rates where they are. So I think they might actually make more money in the long run. I don't know. We'll see. I recommend go to the company investor relations page to determine the correct payout ratio. Services Yahoo can scare you otherwise. Yeah, that's right. But their webpage typically won't have the payout ratio, so you'll have to calculate it yourself. But again, you want to use the adjusted or normalized earnings and not the GAAP earnings when you do that. So that's a good point. Michael says GAAP rhymes with crap, and he's right. Clayton, hadn't seen you in a while, my friends. Good to see you. Welcome back, and everything is well with me. I hope everything is well with you. And excellent breakdown, Kevin. Y'all better hit that thumbs up. Oh, hey, great. Thanks, Russ. Thanks for the reminder to hit that thumbs up. It's always fun to get a few of those thumbs. Frank V is in the house. Good to see you, buddy. Hello, Kevin. I see the APD semis in my community on a regular basis. Yeah, I mean, they are definitely doing some things. I think their biggest issue, similar to Starbucks, is China. And I think it's, the helium gas in China is their biggest issue at the moment. And my thought is that that's going to happen at some point. It might be more than a year. It might be 5 years. But I'm believing that I'm getting a pretty good price on Air products at this point, being and having invested in it prior to all this crash that it had. To be at an average price of 240, below 240, 239 now is not a bad place to be. I'm excited about that in the portfolio. Yeah, so yeah, it is. It's absolutely undervalued. Michael says the mamas and the papas, Monday. And that might be the Karen Carpenter song I was thinking about too. El Dynamico suggests Fun Day Monday. That's not so bad. We'll throw all of these into a a hat and see what happens. IPP isn't really a utility with regulated pricing. Yeah, that's exactly right. They are subject to the wholesale price market. They are not a regulated utility. They are a wholesaler, basically. So yeah, that's exactly right. Thanks for clearing that up, Michael. I didn't say that earlier, and I should have. So Russ has got to run. A great stream. Thanks, my friend. Glad you came. Always love it when you join the stream here. So Kevin, what if you call the show the Wealth Circuit Hour? That's not a bad idea. Huh. I'm going to throw that in the hat too. Can you? Okay, so this is El Dynamico. El Dynamico wants me to do a quick check on Enterprise Products Partners. I think that's the way it's said. So I'm going to, realizing I never took the stuff off the screen to begin with, I'm going to, sorry about that, guys. But that's okay. It's probably easier to look at that than it is to look at my big, ugly face on there. So, all right, EPD, Enterprise Products Partners. So I'll take El Dynamico's comment off of here. And you can see that they have a dividend safety rating, El Dynamico, of 65, which is considered safe for Simply Safe dividends. They have a dividend yield currently of 7.1%. They are trading at a price of $29. So let's take a look at... Oh, I know what's throwing me off. All right, I got it. I'm with it now. Okay. So, first thing to know about Enterprise Products Partners is that they issue a K1. Let me just validate that. Where's it at? Yeah, see here, the taxation is a K1, and what that means is that they it's a little different process for filing your taxes. It's not a qualified dividend. It's not a non-qualified dividend. You are actually a partner. When you buy shares in Enterprise Product Partners, you are a partner in that company, and they will send you the K1 as a partner. So you would then fill that out as a business owner, not just as an investor receiving dividends. So it's another schedule or two. It's not terribly difficult. To be honest with you, I just don't like chasing them around. So I don't invest in those that give me K1s because of that. But it appears to be in pretty good shape. I mean, you can see this dividend growth here. Let me find the. Look at this dividend growth from 2004 to 2023 is, it's just, up and to the right. So that's looking good. They grow at about 3 to 5% per year. So it's pretty consistent. And let's look at their payout ratio, which is, again, based off of adjusted earnings. So it's pretty reasonable at a 57%. The cash flow payout ratio is pretty high, but it is by design that way. The any company that is a partnership like this is required to pay out a certain percentage of its taxable earnings. Let's see, DCF per share. That'd be the way that you would measure that. Let's see if there's anything else cool in here. They are growing their shares. They've been pretty flat for the last 5 or 6 years. The return on invested capital is 11%. That's not terrible. Yeah. Interest coverage looks pretty good. So, yeah, I mean, I think they're fine. I mean, obviously you're buying them for the dividend. And, one thing we could look at is... I didn't even pull. Oh, yeah, I did. Here's Fast Graphs. I got to log into that too. You guys can't look at my password there. All right, let's pull up. Who was that? EPD, right? So Enterprise Products Partners. Yeah, they look to be a little undervalued from Fast Graphs perspective. So, it's not a bad deal. So if that's something you're interested in, you don't mind the K1, it looks like it's pretty reasonable at this point. So those are my thoughts, El Dynamico. So hopefully that was helpful. Now the challenge is finding where I was. Oh, there we go. Let's see. Yeah, so Tutomi says this that VST Vista is his biggest gains in this portfolio. Man, that you got in at a great price, buddy. I'll tell you that was well done, my friend. Let's see. Is that a Doors reference? Keep your eyes on the road and your hands up on the wheel. You know, I don't know because I was never a fan of the Doors, so I don't even know any of their songs. I would probably know the song if I heard it, but it's not something that I listen to. So Michael likes Kevin Mendoza's suggestion, the Wealth Circuit Hour. That's not a bad thought either. Let's see. I wonder if two autonomous vehicles crash into each other, can we defer the blame on the automakers to settle? That's a great question. Yeah, who's at fault? Would it be the guy who programmed the and if it's AI, then it wouldn't really be the programmer. It would be the vehicle itself that didn't learn enough. I don't know, man. I don't know. I'm not there, buddy. Enbridge isn't a K1 entity. I prefer it. Yeah, so Enbridge. I thought, well, Enbridge is Canadian, right? So let me look that up real quick. I think Enbridge is Canadian. I owned Enbridge at one time because I preferred them as well. But then I got the Canadians holding tax out on me and decided that I would rather own other things. So here, let me pull it up here. ENB. I know you can't see it yet, but I will pull it up on the screen. Here we go. Enbridge. It's 70. Let's take a look at its tax. Yeah, Canadian. There it is. Canadian taxes, and they may withhold taxes. And if I had it in an after-tax account, so it did. They did withhold tax, Canadian tax for me, and it's just something I just don't want to deal with at tax time. My taxes are complicated enough as it is, so I don't need to cause myself problems. So anyway, yeah, Enterprise Partners is an MLP. That's right. That's the exact lyric from the Doors. That's really cool. I had no idea. So, so OJ wants to know, how are the bees? Well, I actually did check the bees. I've got 3 hives now. I think I told you guys that. 3 hives of bees, and I checked them all today. Hive number 1, which is the blue hive. So there's a hive that's blue in color. It is the blue hive. That is a new package that I got this year. They are doing well, except that there was a queen cell in there. I don't see any eggs or any larvae, but there is capped brood. And if you don't know what that means that it doesn't look like the queen's there anymore. So maybe she took some of the bees with her. I'm not really sure. There is a queen cell. They're growing another queen. I basically just put it back together and I let them do their thing. The brown hive, same thing, except that happened maybe a couple of weeks ago. So looks like the queen is released now, and maybe she's on her mating flights, but she should be back soon laying some eggs. But that swarm that I caught, they are doing so well. They have eggs, they have larvae, they have capped brood, they have honey. They are knocking it out of the park. So I appreciate you asking, OJ. It's if you're not a bee person, what I just said probably doesn't matter to you, but for a bee guy, it means a lot when you can see eggs and larvae. Can you look at 2 more stocks? AWK, AWR, and those are both water companies, I think. American Water, I'll have to look up AWK. And again, I have not taken the screen down, so that'll be a quickie. AWK, American Water Works, it is a 70, and then AWR, American States Water. I used to own AWR, just for full disclosure. It's dividend safety of 98. It has a little bit better dividend yield, 2.49, whereas American States Water is 2.37, so it's not really enough to worry about. What I would look at here is, let's look at Morningstar, and let's look at AWR. See what the valuation, and they don't value American States Water. They do have a calculated value of 76.85 with a price of 69.17. And let's see if they have anything for AWK. And that is they do actually value this one with a human actually looks at this. They have a fair value of 135 with a price of 118.52. Let's see. So I used to own AWR, which is American States Water, and I sold it probably, I don't know, a year and a half ago or so, maybe even 2 years ago. It's probably 2 years ago. And the reason I sold it is that it had gotten way overvalued. So I think they're back into a reasonable area. I wouldn't invest in them if it got back up again, but it looks like they're in reasonable territory. Everybody needs water, so if you're looking for a safe investment in a regulated industry and it's a good valuation, then I don't have any issues with either AWK or AWR. Yeah, you do get the tax credit, but you have to fill out that form and stuff. And since I do my own taxes, I just want to keep it as simple as I possibly can. So yes, they hold the tax, but you get a credit here for it. Yeah, that's true. That's on the Enbridge. So El Dynamico says, anybody seen the movie Bicentennial Man with Robin Williams? I think we are headed that way. I have not seen that movie. I'll have to look into that. I don't know. Bicentennial Man by Robin Williams. I'll look that up by El Dynamico. I don't think I've ever seen that, but I've never been. Oh, let me take this stuff off. Hold on. There, is that better? No, I know it's not, but hey, anyway. So yeah, I've never seen that movie, but I will tell you that I am not the encyclopedia of movie watching anyway. I tend to do other things. I watch movies from time to time, but it's really when I've got a good 2 hours to spend with the grandkids so close, and bees and chickens and all that kind of stuff. It's not often that I have a couple of hours to watch a movie, but I'm not opposed to them. I just don't watch them too much. Grooming new dancing queens, ABBA. That's what's the name of that movie? There's a movie. Now that I said I don't watch movies, my wife loves it. It is the movie about ABBA, or it's got all the ABBA songs in it. It's got the guy who played, I think he played 007, one of the actors in there. Meryl, yeah, there it is, Michael. Yeah, good call. Mamma Mia. She loves that. And anytime she can put it on the television, she does that, and I go straight to bed. So that's kind of where we are. So, hey, we've got no other questions in the stream. Anybody got anything? Let me think of something that, let's see. You love it too, Michael. That's good. I mean, I love the music, but and the people who were cast in the movie, you don't think of them as being great vocalists, but they are. And like one of them is the mother of Sheldon Cooper off the Big Bang Theory, right? But they are all very good vocalists. It's just a little corny for me, and so anyway. Great question, OJ. Does my wife like to pick stocks? She does not. I talk to her about what we do, and when we're driving places, like if we're going to South Carolina or whatever, I will put videos on, like my buddy Ryan Williams, like my buddy Russ, and she will listen to those, and she comes up with great questions. But she's not interested in actually diving in and picking stocks. She understands what we're doing because it's important to me that she does, because at some point, odds are that she will outlive me, and if that's the case, I don't want to have something going that she knows nothing about. So she's into what we're doing here, but she doesn't like the um, act of picking the stocks. Pat wants to know about AbbVie. AbbVie is, a pharmaceutical company. It was a spinoff of, and my brain just went blank on it. Abbott Labs, spinoff of that. They have the product Humira, and Humira is a great product, and it has come off of patent. So that means that other people can knock it off from a what do you call that? A generic drug perspective. So, but it is not getting hit as much as they originally thought. Plus, they have two other bang up drugs coming behind it. Skyrizi is one of them, and I always forget the other one. So, I think AbbVie has. I owned AbbVie at one time. I think my share price was around 105. I sold it around 160, I think, 150, 160, and have not looked back. So I think I would rather own something like Johnson and Johnson. But those are my thoughts on AbbVie, Pat. It's a great company. I think they're solid. I think their products are solid. I don't know if it might be a little bit overvalued at this point, though. That's kind of where my head's at. Let's see. So El Dynamico says, my chicken likes to wear garter belts while picking stocks. Oh, that would be funny. That would be, if I could get one to wear one, it would be funny. So Tutomi wants to know about PLD. So we are getting close to the end. So let's go ahead and take a look. PLD. Prologis. That's an industrial real estate investment trust. It's got a dividend safety rating that's safe. And let's take a look at some of these factors. Their payout ratio is 69%. That should be of a DCF. Let's see. FFO. Adjusted FFO payout ratio. Looks like next 12 months is going to be a little rough for them. Tutomi, they're going to be at about an 86% payout ratio. It's not unheard of in their past, but it's been about 10 years since they've had one that high. Might be something you want to take a look at. So it looks like they're going to have a little bit of struggle. I don't know what's causing it. Their return on invested capital is pretty small. Let's take a look at their dividend. Dividend's about 3.69%. I think personally you can find a better business and yield in a real estate investment trust outside of this. But it's not a terrible stock. I just think you can do better. That's my personal thought. Are my chickens related? All right. So I have right now, I have 12 and 26. So I have 38 chickens at the moment. And 26 of them are going to be 7 weeks old tomorrow. They need to be 8 weeks old before we process them. And so then probably in another couple of weeks, I'll be back down to 12 chickens. Those 12 chickens, 11 of them came from the same hatchery on the same day. I don't know if they're related, but I kind of guess that they are. So maybe 11 of them. The 26 came from the same hatchery on the same day. Maybe those 26 are related to, I don't know, but I think, yeah, it's hard to tell because I don't know how many roosters and hens they have, you know. So Michael to Madeline Khan. I'm not sure what that means, buddy. You have to give me something else. Do you like ARCC or ARDC? I like ARCC. Oh, I never did pull up Prologis for you. But anyway, that's okay. I like ARCC. I'm not sure what ARDC is. Let's see. ARDC, Ares Dynamic Credit Allocation Fund. That's at a 50. It's a high dividend yield. Net asset value. Yeah, not wild about ARDC. The dividend growth is in the last 5 years is only 1% per year. Now, I realize that the dividend yield is 10%. So how much growth are you going to get? But, you know, for me, I like to have a little bit of growth in there. But it's a closed-end fund as well. I typically don't invest in the closed-end funds. Let's see. All right. Well, there you go. So let me just make sure. Here, I'll pull this up. We've got negative 1 minute left. So this will be the last thing that we do here. So ARCC, this is ARDC. You can see that the dividend safety ratings is a 50. Dividend yield is 10%. Let's look at ARCC. ARCC, Ares Capital. I like Ares Capital. It's a 59. Dividend safety rating, 9.29%. Their recent dividend growth is 0, but their last 5 years is 5%. So, I mean, you can see that back in the financial crisis, they struggled a little bit. But who didn't? What financial company did not struggle? And, you know, coming in at, you know, this year. So I'd say the last 5 years, 5% growth. I like that a lot. But if I were to pick, if I only had one business development company, which is what Ares Capital is, it's a business development company. If I had one of those to pick, I would pick Main Street Capital. If I had two, if I wanted two of them, it would be Main Street Capital and Ares Capital, ARCC. So I do like ARCC. It would be number 2, though, in my list of choices for a business development company. So, all right. So with that, hey, Michael says, sorry for his prolific commentary. My friend, that's what makes these live streams worthwhile is prolific commentary. I am glad you're here, and I love your commentary, man. Don't stop. Don't, you know, keep it coming. That's what this is about. We're here about having a good time. So, all right, guys, it has been an hour and 3 minutes and 12 seconds. So I'm going to go ahead and sign off here. But before I do that, I have to find my exit video. I didn't prepare that very well. All right, so if you guys are ready, here we go. Here's the exit video.